Hello, Kurt Jackson, retirement income strategist with KJ Financial in Liberty, Missouri here. Hey, I want to thank you for joining us. Today we're going to talk about finding affordable ways to help protect us from many of the what ifs that we worry about happening to us through in our journey through life. You know, these types of things that can happen unexpectedly and really derail all that we're doing and all that we want for our future. See, anytime these what ifs happen, they can cause huge disruptions in our lives and also cause huge amounts of financial distress for that time period and going forward. So while our main focus is always getting them the most lifelong, always increasing retirement cash flow for the least amount of money, we also try to find affordable ways to provide our clients the most protections that they're likely to need as they go through life. Today we're going to share some case studies where this affordable solution that we're talking about was able to help out people just like you when those what ifs actually happened. Okay. Let's start with Sue. You know, Sue is 60 years old. She ended up getting one of these special 20-year term life policies with living benefits. It had a face amount of $300,000. When Sue reached age 64, she became ill and she qualified for the chronic illness accelerated death benefit because she was unable at that point in time to bathe and dress herself, which are two of the 6 activities of daily living. She needed in-home care and wanted to hire a nurse to help her. Her health insurance didn't cover the expense of the nurse, so she chose to accelerate a portion of her death benefit to help to help pay for those costs. Now, since Sue's condition was severe, her life expectancy was estimated by the company to be 4 years. She chose to accelerate the maximum benefit of 24% of the face amount of $300,000 per year. Okay, so Sue had only paid in about $7,668 in total premiums for this special term life with living benefits policy. Yet she was able to receive $58,914 that year to help with her expenses. Sue has the option to accelerate 24% of the face amount on an annual basis. Okay. All right, next, let's meet Bill. Bill's 50. He's a successful executive and the father of 2 young kids, 10 and 12. Okay. To ensure that his children would be able to attend college, no matter what happened to him, he chose to purchase one of these special term life policies with living benefits. Had a 15-year term and a face amount of $400,000. His total monthly premium outlay was $74.58 per month. Now, at age 55, Bill suffers an accidental injury which requires a major organ transplant. He's diagnosed with a critical illness which has a severe impact on his life expectancy. There's no waiting period if the critical illness results from an accident, so Bill's entitled to accelerate benefits right away. At the time of Bill's accident, he had paid out $4,469 in total premiums. And after the company analyzed his case, they determined he could qualify for an accelerated death benefit of $266,761, which was the maximum he could receive after they had calculated his life expectancy from 90% of the $400,000, which left him a $40,000 remaining balance, or I'm sorry, not balance, but remaining death benefit. Okay. Next, let's meet Julie. Julie's 35. She recently purchased her first home. She's got a 30-year mortgage for $300,000. She purchased one of the special term life policies with living benefits. Okay. For $300,000 and a 30-year term, and her total premium outlay is just $26.32 per month. At age 42, she's involved in an automobile accident, which results in a serious back injury that limits her mobility. So at age 45, Julie is diagnosed with a chronic illness, and she accelerates her death benefit to help pay her current living and medical expenses. Since Julie's policy has been in force since she was 35, she's met the 2-year waiting period, which she would have met anyway because it was due to an accident. Julie's paid a total of $3,158 in total premiums. Since she can't do 2 of the 6 activities of daily life and the severity of the diagnosis is moderate, she's able to pull out 24% of $102,387 adjusted life expectancy accelerated death benefit. So that's $24,573 per year. If she takes out that amount in year one and happened to pass away in year two, the remaining death benefit would have been $228,000. If she didn't, and she was able to qualify for the benefit again, the next year she could take 24% of her remaining adjusted accelerated death benefit. Okay? Hope that makes sense. Gets a little complex. The bottom line is there's going to be money available there. Next, let's meet Sally. Sally's 40. She's a small business owner who recently took out a loan for $250,000. She makes the decision to purchase one of these special term life insurance policies with the living benefits in the amount of $250,000 for a term of 25 years. Her total premium outlay is $46.87 a month. At age 48, Sally suffers a severe stroke. She's diagnosed with a critical illness, which has a severe impact on her life expectancy. Since Sally has long ago met the 30-day waiting period required after the policy is in force to accelerate benefits, she chooses to do so immediately. So Sally's total premium outlay at the time of her stroke was about $4,500. After the company analyzed her file, they determined she was eligible to accelerate $150,531 of the maximum eligible 90% of her death benefit. She will still have $25,000 in death benefit remaining. Okay. All right. Now, next let's meet John. John's 45. He earns $50,000 a year, and he's been advised that he needs coverage in the amount of 10 times his income. He follows that advice and purchases one of the special term life policies with living benefits with a face amount of $500,000 and a monthly premium of $61.06 per month. At age 53, John is diagnosed with pancreatic cancer. His terminal illness has a severe impact on his life expectancy, and John is entitled to accelerate 100% of his death benefit immediately. Okay? John had paid $5,862 in total premiums, and he was eligible to receive $471,715 in accelerated death benefits. Since he chose to elect the accelerated death benefits on 100% of his $500,000 death benefit, there's no remaining death benefit. Okay. See, John's now able to use that money to undergo special cancer treatment that his health insurance won't pay for, or he could use some of it to take his family on a vacation of a lifetime, or maybe he could pay to have his loved ones all come back for one last family reunion. The key is that he has the money to do whatever he wants to do with it. Okay, he's got choice. He's got control over the situation, at least some control. Lastly, let's meet Dave. Dave's 40. He purchases a 30-year special term life policy with living benefits with a face amount of $500,000. At the age of 45, he suffers a severe heart attack, which the company has found to have a significant reduction in his life expectancy. He elects to accelerate the most he's allowed to accelerate, 90% of the $500,000, which gives him $295,572. So after paying $4,575 in premiums over the 5 years, Dave and his family have $295,572 to do whatever he needs to with the cash. He could pay medical bills, he could replace income, pay the mortgage, even fund his kids' education. But more importantly, he doesn't have to liquidate the funds from his 401k or his savings or his retirement funds. And he still has $50,000 in face amount of the life insurance for the family when he passes away. Now, when Dave purchased this, he also purchased an additional life insurance policy without the living benefits for $750,000. So if the company's correct, okay, in their assessment that his life expectancy has been cut short, his family will have $800,000 in death benefits to pay bills going forward. And more than likely, thanks to his special life insurance policy with living benefits, his family shouldn't have any old medical bills or bills they were behind on to get caught up with that $800,000 if he does pass away. Hasn't he left his family in a very solid financial position? So now there's other ways to help with these types of what ifs, but we haven't found any other ways to provide this much protection in such an affordable way. How important is it to you to make sure that your loved ones are taken care of financially if something happens to you? Does it make sense to have this type of protection in your life, especially when it is as affordable as it is? We know that nobody gets excited about life insurance, at least the traditional type that just pays your loved ones if you die. I mean, you got to die first for the benefits to kick in. While it's great that you're doing that for your family, it certainly isn't exciting for you. Okay. So with this new type of life insurance, it offers so many benefits that not only helps your loved ones if you pass away, it provides much needed financial help if some of the worst of the what ifs happen to you. Now, this is something that you might even think about if you have parents that are still alive, assuming that they're still in pretty good health. This could provide them and you with some substantial financial assistance if they end up needing care later in life. Now, these can be structured up to age 90. They have the ability to convert to a permanent life insurance policy before the age of 70. If you have someone that's in excellent health and they qualify for the Preferred Plus status, that convertibility is available up to the age of 75. Okay. Would it make sense to explore whether or not this might make sense for you to help better protect yourself and your loved ones? Okay. If so, you can, my information is up on the screen there. You've got my direct line. That's the best one to call me at. My email. We can even set up and do this online at www.meetme.so/Kurt Jackson. Just go on there and schedule an a retirement income strategy session, and we can do that online. There's no cost or obligation for this conversation to see if it might make sense or not for you. So, do you currently have this type of protection? Can you think of a scenario where it wouldn't be smart to have this type of protection so you and your loved ones don't have to suffer financially if you experience any one of these many different situations? Whether I hear from you or not, I certainly hope that none of these what ifs ever impact you or your loved ones. And I hope you have a great retirement. Thanks for visiting us. I hope to hear from you soon.